Welcome to Midday. We're visiting now with Mark Bertoli. Welcome.
How you doing?
I'm great. Yeah, for a smoky day, not too bad.
I know.
You're visiting us from Abbott Wealth Management, of course.
Absolutely.
You have a very interesting topic today. I'm fascinated with what's happening in the markets. We see all the turmoil that's happening, and yet the markets seem to project something different than I at least might anticipate.
Right. We're breaking all-time highs every day in the States, it seems, and so what I wanted to do today was kind of bring us back to earth and talk about some reality.
Find a little bit of realistic balance. What's happening
so just bring up that first slide, and it's funny. I don't know why they call it common sense, because there's nothing common about it. Dale Carnegie said this in 1930. It applies
so relevant
to so many things in life, but right now I think it's a good time to really read this and think about your investments.
Okay.
So let's just go to the next slide here for a second. And I often do this with clients, and I say, if I gave you $2 million today, and I said by next Friday you had to buy a business here in Kamloops, what would you look for? So, you know, some of the things, you would want a company that's difficult to compete with, difficult to live without, and also very difficult to replicate. So it has competitive advantage.
Okay, some kind of an edge on everybody else.
So what you would want to do is take your new $2 million check and you would go right to your accountant and say, okay, I'm looking at this company, what do you think? Okay. And the accountant's going to say something. He's going to say, okay, I want to see 5 years of financials of that company. And if he does a really good job, he's going to phone their suppliers. Do they pay their bills on time? And phone their customers. Are you happy with this company?
What's the dirt?
Are you going to continue to deal with them?
Yes.
Based on that analysis, you will make the decision whether or not to buy the company.
Okay.
Right.
So let's give it a try. I'll be waiting for my check at the end of the day.
Okay, there you go.
Let's see what happens.
We'll see how far it goes.
Yes, exactly.
The point being that you're going to buy a company that has value, that you're going to use common sense in the decision-making process, and you're going to use business analysis to discover whether or not you want to buy that company.
Okay.
Okay.
And it might not always be the first thing that jumps out at you, maybe not the sexiest thing, but
no, it's
something with a trajectory.
You know, you think about businesses around town that have been here a long time, and you know, I look at Home Hardware and how it's grown over the years. Those are solid companies, right? So the funny thing is, when we throw common sense out the window, all of a sudden we start, as an investor, buying companies we know nothing about with pure speculation, and in the end, that usually doesn't end too well. Right. So, you know, going back to the next slide is it broken or does it appear to be broken? So. A lesson about price-earnings ratios. So right now, the Canadian stock market is trading at about 22 times the earnings. So if a company made $1,000, you would expect to pay $22,000 to buy it. Okay, that's price-earnings ratio. That is a measure of value. It's the measure of what you're willing to pay for a company relative to what it makes. In other words, in 22 years, that company would pay itself off, because 1 year's earnings times 22, right? So why I want to talk about common sense today is that I want to look at some other things that are going on in the markets. So we're hitting all-time highs in the United States. If we can bring up the next slide, there's a few companies I looked at here. Netflix, Amazon, Twitter, and Royal Bank of Canada.
The ones that everybody knows.
Okay, so Netflix, 2016, traded at 421 times its earnings. So the market normally is at 22 times earnings. It's trading at 421, or it would take 421 years for its earnings to pay itself off. Crazy. Amazon, right now, 251 times earnings. It's a great company. No question about it. It's got a great future in front of it. However, if you bought an apartment building and you paid way too much for it, the rent is never going to pay for it, and it's never going to be a good investment. There's the criteria of paying the right amount for a company is one of the critical links in being successful as an investor. Twitter. Now, Twitter is not even making money. It actually has a negative PE ratio. Next year, they're projecting they may make a little bit of money. They would be at 1,629 times earnings. When the technology bubble burst in 2000, companies were trading at 200 times earnings. People lost 75% of their money.
Wow.
Now, to put that in perspective, here we have the Royal Bank. Its current price earnings is 12.88 to 1, less than the market. It pays a dividend. So if you had $1,000 or $100,000 in RBC stock, you would get about $3,600 because you own that company and it's very profitable. It's trading at 12 times earnings and it makes $10 billion a year.
Wow.
Okay?
Yeah.
Twitter is losing money.
It's currently losing money.
If it made money, would be trading at 1,600 times earnings.
Which is so interesting because you look at those things and you think, well, Twitter must be a safe place to put your money because it's everywhere. It's huge.
It's only if it makes money.
Yes.
Right? And you know, there's speculative investing, but you can get caught in that game. I call it the shiny lure. We are very grounded. We look at the business analytics. We right now are buying a lot of energy companies. Suncor is probably, when you look back 5 years from now, we'll look back and say that was the buying opportunity of a lifetime. You know, so there's lots of things. I guess the point being, nothing common about common sense, so I don't know why they call it that. So we're going to apply it to the markets today. Take a good look. If you've been fortunate enough to run those stocks up, maybe it's time to take some of that profit off the table and own something solid. The RBC is trading at a low multiple and a low price earnings ratio right now. It's actually a good buy. Its earnings are fabulous. There's lots of other companies like that out there.
Okay, so part of that common sense would probably be knowing to go to somebody who's educated and experienced and ask where's the best place to invest, to look to put this money.
That's part of it too.
Abbott Wealth Management is a great place to go to find out more information and to get some help in these areas. You can visit abbottwealth.com or email info@abbottwealth.com. Thank you so much. It's always a great education. I love it when you guys stop by. We'll be back with more Midday in just a moment.